Buying a home in 2026 is not the same as it was even 2 years ago. Rates are different, some guidelines are tighter, and one wrong move can cost you the house. In this video, I'm going to walk you through step by step exactly how to buy a home the right way. So, step one, you've got to know your numbers. I talked about pre-approvals in previous videos. You've got to have that done. So before you look at Zillow, before you call a realtor, and certainly before you fall in love with a house, you need to know your numbers. Let's talk credit score. You get 3 free credit reports, one from each of the 3 bureaus every year. Pull it, make use of it. Not only that, make sure that nothing that is on there shouldn't be. Are there debts that you've paid off that are still on there? Are there debts that you've never accrued that are on there? Those are big issues. Wipe that clean and make sure that everything is right before you start looking, because it will affect you. So the next thing is going to be income. Now, if you're a W-2 employee and you get the same thing every 2 weeks or every month, whatever you get paid, that's easy. But if you're a 1099, or if even part of your income comes from commissions, that's going to fluctuate. It's going to go up and down. You're going to have great months, you're going to have slow months. They're looking for the average over the last year, over the last 2 years. Okay? Now, your next thing is going to be estimated cash to close. This is a big one. A lot of people go out, they save up for their down payment, but they didn't account for the, $7,000 to $10,000 that they're going to have to bring for closing cost. FHA loan. Closing cost on an FHA loan is high because of that upfront mortgage insurance premium. Make sure you have enough reserves to not only cover your down payment, but to cover possible closing cost. And furthermore, once you move into the house, you're really going to need some extra reserves, because houses, unfortunately, come with problems. 2 months after you move in, your hot water heater could go out. A part on your heat pump could go out. You have to be able to address those things when they come up. The next thing is going to be 2 months of bank statements. If you've got $20,000 in cash under your mattress, well, one, you're probably not sleeping very well. And two, you need to get that money in the bank. And you need to get it in the bank at least 60 days before you start looking for a loan. That's called seasoning. Those funds have to be seasoned in a bank account for 60 days at least. Okay, step 3, choosing the right loan program. Now, you've always got conventional. That's a general loan that has a minimum of 3% down. You're going to pay mortgage insurance on that. Most people try to get as close to 20% down as they can. In today's market, that may not be feasible. So you have other options. You have FHA loan. If your credit score is lower, if your DTI is a little bit lower, FHA may be right for you. Now, that does require a minimum of a 3.5% down, and it comes with upfront mortgage insurance, which is a big chunk at closing, and monthly mortgage insurance. That with an FHA loan, monthly mortgage insurance never expires. It is there for the life of the loan. With conventional, once you reach 20% equity in your home, that mortgage insurance payment drops off. It's gone. Doesn't happen with FHA. 2 other great programs are VA, Veterans Administration Loans. So if you served, you are eligible for VA loan. They have a 0% down payment option, if you need to do that. And they also have very flexible credit score and flexible DTI, and they can use your military benefits to qualify you. So that's good. One that a lot of people don't talk about, and I live in a rural area, so I like it. It's the USDA loan. Again, USDA loan comes with certain restrictions. One, your property has to be located in what USDA terms a rural area. And I'll put in the description below a link. They have a whole portal where you can go in and type an address in and see if it qualifies or not. Not only does the property have to qualify, you as the buyer have to qualify, meaning you can't make more than 80% of the area median income. They also have another portal that I will put in the description below to see what your area median income for the place is that you're looking to buy. Step 4, this is where it gets fun. This is where you go find a realtor, start looking at houses, and hopefully making some offers. Now, what do you have to keep in mind? When you make an offer on a house, you're going to have to accompany that offer with some earnest money. Typically $5,000, $10,000. Now this will be credited toward your down payment at closing, but it's letting the seller know that you are in fact serious about buying their house. So serious, in fact, that you're willing to put up a good chunk of money. You'll get that back as long as, generally speaking, you uphold your end of the contract. There are situations where you could lose your earnest money, yes, but just talk to your realtor about this. They can advise you. So after the earnest money, after you have a contract, you're ratified, you can have contingencies in that contract. Contingencies mean things like, this house is kind of old. I want to make sure I can have a home inspection. So you would make it contingent on a home inspection. Now you'd have to pay for that, but it's better to know than to get into a house that's really crappy and you have all kinds of expenses coming up. Another contingency is pretty common is a financing contingency. Now, if you show up with a good, solid pre-approval letter, that financing contingency is going to be easy because the hard work has already been done. If you go house shopping without a pre-approval, that financing contingency is going to start to maybe eat at those buyers a little bit. They're going to start saying, well, I've got this offer over here that they came with a pre-approval letter. Yes, it's contingent on financing, but this guy doesn't even have a pre-approval letter, so I'm going to go with the most likely one that's going to be able to get the loan, the one with the pre-approval. Really good pre-approvals can also compete with cash offers, believe it or not. Okay, that was the fun part. Now comes the not so fun part. Underwriting, appraisals, the stressful stuff. So you've made your strong offer, you got a contract, you got a loan, the loan goes to underwriting. That's where they comb through all of your documents. They comb through those bank statements. They comb through those W-2s. They comb through everything. And you think you've provided them enough, they're going to ask for more. I can almost guarantee it. The lender will order an appraisal. The appraisal will give you a value of the home. That appraisal is not for you. It's for the lender. They want to make sure that they're loaning money on a house that's worth it. In other words, if your offer on the house and your contract on the house is, let's just say, $200,000, and the appraisal comes in at $190,000, it's not going to be good, but there are options. Potentially, you could bring the extra $10,000 to closing to make it right. You could renegotiate your contract. There are other options that I'll get into later. That's a whole nother video. So just know that the appraisal is going to have to get done. And the appraisal isn't the appraiser looks it up on Zillow and sees what it is. They actually compare the house that you're buying to comparable houses in the area, and they make adjustments for size, number of bedrooms, things like that. It's an actual value. Okay, when you finally get there, it's coming up on closing day. You'll do what's called a final walkthrough. You and your realtor will go back to the house that you're trying to buy. You will do a final walkthrough of the house. You will make sure that, one, it's still in the same condition that it was a month ago when you saw it. There hasn't been a kitchen fire or anything crazy like that. Maybe the front yard is flooding and you didn't know that and now it is. And so it gives you a last chance to get eyes on the property and really be sure that this is the house for you. You go to the closing table, cash is wired, you sign, approximately 3,842 pieces of paper at closing. I'm exaggerating, but it's a lot. When you're buying a house and getting a loan on it especially, if you're buying it in cash, you sign like 5 papers and you're done. But if you're getting a loan, it's disclosure after disclosure, after paper, after paper, after paper. It can be exhausting, so just be prepared for that when you go to closing. You're going to be there for a few minutes and you're going to be signing a lot of papers. And then you get the keys to your new house and you move in. Congratulations, you're a homeowner. As always, if you have any questions, shoot them in the comments. And if you happen to be buying in Virginia and would like a personalized mortgage game plan before you start shopping, schedule a call with me, reach out to me. I'm available anytime.